years. Joining us today is Dr. Nassim Nicholas Taleb, and he will be in conversation with ET Now's managing editor Nikunj Dalmia on the topic, neither black swan nor white swan, don't listen to pseudo experts. So with that, over to you, Nikunj.
I must say, Sumit, you've been slightly unfair in introducing Mr. Taleb. We've always introduced him as a financial author, as a risk taker. His most famous work, Black Swan, is something which everyone knows of because it predicted the fall of financial markets in 2008. But hold on, I'm going to read a passage from that book where he actually predicted an epidemic 13 years ago. And the passage goes like this: as we travel more on this planet, epidemics will become more acute. I quote him, we will have a germ population dominated by few numbers, and the successful killer will spread vastly more effectively. Nassim Taleb, 2007. You saw this coming 13 years ago.
Yeah, I mean, is there's nothing particularly interesting in predicting pandemics because they've been happening throughout history, and we got even movies about pandemics and future pandemics. The central point is that our environment today makes these pandemics vastly more, dangerous because they spread much faster. And that is a problem. If we didn't have this connectivity that we have today, say we were in 1950, we wouldn't be talking now about this virus. It would have taken much longer to reach, maybe years to reach, some parts of the world. So so this is coming from a nonlinear effect from connectivity, a winner take all. Just like in the Black Swan, and I explain it as follows. When you have insulated islands, you have a lot more species per square meter. But as you expand to a continent, you see, you will have winner-take-all effects with some species dominating and small species disappearing. So we're seeing it in business-wise. Look at Google. 100 years ago, it would have been impossible for one company to dominate the planet in no time. I mean, it took 4 or 5 years for Google to really own the planet in its field. So get used to this, and this applies to everything: cultural life, sports, fame, and of course, viruses.
When you say get used to this, are you making a case that you're not optimistic on a medical discovery and vaccine is not going to be discovered?
Okay, so what we're saying, get used to this, is we're going to have more viruses coming. Okay, that's one. Maybe not tomorrow, or maybe tomorrow. Maybe we'll have antibiotic-resistant bacteria, which are vastly worse. We were lucky with this one. I'd say honestly, this one spread very fast, unexpectedly for people who don't understand connectivity, but it is still relatively milder than other viruses, say polio, smallpox, that can, really ravage a country. So now, am I optimistic on medical discovery? I am what I call realistic, okay? We've had AIDS now for about, 37 years, 35 years, okay? We still don't have a cure. We have a treatment. We don't have a vaccine. So herpes, for example, this may look more like herpes than respiratory disease. We still don't know. Herpes goes away and then comes back in the same person, you see. So it stays dormant. It's not common to respiratory diseases, but we now we're realizing this may not be even the respiratory disease. So what I would say is, I'm very hopeful that we'll have a cure, a treatment, a pill you take if you're at the first cough. Very hopeful, but I cannot rely on it. I'm not going to run my life based on hope. Run my life based on hard information. And we have been disappointed by by medicine. At the same time, we have had surprises, nice surprises. Antibiotics came as a nice surprise. Now some treatment for melanoma cancer came as a nice surprise, but you can't really bank on that. Now we have practically every single researcher in medicine on the planet is involved in some way or another in this. Okay, will something come out of it? We don't know.
So whom should one believe, Mr. Taleb? The maximist who say that the only way to survive is that you stay at home, maintain social distancing, or the minimalistic? There are few in your country who say that, look, you got to come back to normal.
Okay, so let me tell you the problem with this reasoning is a lot of people have been promoting, maybe often because they're connected to the travel industry, or casinos or something like that, losing money. They've been promoting the idea that it's either the economy, all right, or the virus, not realizing, as many countries have been discovering, New Zealand, for example, Taiwan, that effectively the best way to help your economy is through a victory over the virus. That's what's central. The other myth there is that these people are promoting, that they think that the economic drop comes from the measures, not from the virus. But now there's evidence in practically every country, even Sweden, where the government did the minimum, okay? Even Sweden, that restaurant bills experienced a plunge, okay, economic life experienced a plunge, okay, except for cosmetic. And then as I show you pictures of some people in restaurants, most restaurants are empty, and these pictures contradict the hard data we have about consumer behavior. We know, for example, that a lot of companies I'm associated with are not going to go back, even if the government said, okay, everything is normal tomorrow. We're not going to go back to work if we can work from home. We're not going to expose ourselves to a virus if we can help it, okay? And practically everything elective has been canceled. If you see conferences like this conference, okay, if there's the smallest risk, it will all take place next year or next time we're going to do it online. You see, if there's the smallest risk. So what's happening, it is not the measures against the virus, it's a natural human response, and the problem, the economic problems are vastly greater coming from the virus than they claim.
So I'll turn your attention now to the economy. Let's first start with financial markets. There are 4 factors, Mr. Taleb, which are at play. Medical crisis, economic crisis, oil crisis, and central bank crisis. These 4 factors have never come together. And yet markets are at, Nasdaq is in the green for the year and Dow is hardly down 17-18%. Are you a bit surprised that when we are using words like pandemic and crisis and panic and fear, markets are behaving as if they are Teflon coated?
Okay, so there are 2 issues here. The first one is some segments, more reflected in Nasdaq than other indices, some segments, such as technology, and now we're using technology, Zoom. Okay, so all these technologies visibly have rallied because they've been displacing, okay, travels to conferences. So it's more reflected in Nasdaq than in airline stocks that went down big time and probably will not easily recover. So now, you have to think that every time a crisis hits, you're going to have a lot of losers, but you also have winners. And the winners here are the industries that are capable of adapting. So the travel industry may have not adapted, they may not have ideas for the time being, and people are starting to drive their car instead of flying. Okay, so airline will not do well, hotels will not do well, Airbnb or other similar things will not do well, but some people are doing very well. People selling you, for example, ways to disinfect the room. All right. You go to your office, you can disinfect it. These are doing well. People involved in selling masks, they're doing well. A lot of Amazon is doing phenomenal, right? People who deliver. So we have a shift in the economy from one sector to the other. That's the first point. The second point is, and that's something I learned sorely, all right, as a trader, that practically every crisis leads to an overreaction on the part of government that leads to stocks rallying abnormally, because they inject so much liquidity they target the stock market and they inject liquidity. And that started in 1987. In 1987, we had a crash, and the stock markets were still positive on that period. Why? Because Alan Greenspan, the former Fed chairman, realized you had to print, okay? Or print or lower interest rates. Now the Federal Reserve has lost one weapon, interest rates, because at zero you can't really go negative. There are arbitrages, but they have the monetary policy arm is not just lowering rates. They can print money to buy your commercial paper. Okay, the commercial paper of the Maltese Bank in New York, they buy it. Anything they see that's on sale, they buy. So that definitely will prop up the stock market for a while. But remember, okay, nothing is permanent. Okay. When they stop buying, or if they realize that what they're doing may be inflationary, okay, then things go back to normal. So the one thing I've learned in the life of 37 years since I started trading, very counterintuitive, is that recessions are very good for stocks because the reaction to recessions makes stocks rally, and booms are very, 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 very bad. They make stocks very volatile because, of course, they've got to raise rates and people have substitutions into bonds. So this is one of the reasons why stocks are not collapsing. But if outside the stock market, okay, which is investor-led, by people who just put money but not work, if you walk around, you see nothing but businesses closed. So you have entire sector that will not come back. So number one, rotation from sectors like real estate will do very poorly in the office building, okay, and of course in retail because people are buying now on Amazon will do poorly. Other industries doing well, and over time the economy overall will adapt to that. Will adapt in the sense that I'm adapted. Look, I'm a professor. I have a studio now in my home where I have a blackboard to lecture on a blackboard. I'm adapted, and it's actually a lot cheaper for universities or for conferences to take place online. Okay, you don't have to fly people in. You don't have to clean the offices. You don't have to, provide food. Everything's much more convenient, and you're cutting down on commuting time for a lot of employees. So I am adapted in that sense, and I hope for the best. But if it doesn't happen, I am adapted. A lot of farmers also are adapting. So we have an adaptation period. It seems to me that within 2 or 3 months we'll be so adapted to this that some people will thrive and will even regret normalcy. But I don't think we will have normalcy for one reason. Unless there's a miracle cure, and we know what happens with miracle cures. You have, they make the front page of, at a time there was a rule, if a cure makes the front page of Newsweek, it's not a cure. Right, that was the rule in 30 years ago. So like interferon, cure for all viruses, no. Okay, so if we have a cure, of course, people will wait for side effects, failures, maybe a vaccine that doesn't really adapt to new mutations of the virus. So even if we have a cure, people will still be paranoid. Okay. And will not gather in bars unless, we'll talk about young people maybe, but reasonable people will not gather in bars, will not go to crowded places, will not get into crowded elevators, will not go to crowded, if they have the chance. And it looks like they have the chance, you see. And even the restaurant business can adapt. Like I'm now in Atlanta as a refugee, but I have a place here, and I'm enjoying it. And I've noticed that there are restaurants that are entirely outdoors. And these can thrive in this new environment with the proper distancing and ventilation. Okay, but of course you can't do that in the middle of the winter in New York. So there'll be losers, permanent losers, even if we have a semi-cure for the virus, or announcement for a cure. It will take a long time for people to really believe that it's risk-free to go to crowded places.
India has so far managed to contain the virus. On the medical front, the lockdown has been a success. But do you think in the medium term and in the short term, this lockdown is going to cost Indian economy a lot?
I think that it's a false economy again. It's a false economy. Maybe the money you've saved from a short lockdown, you see, when you have a short lockdown, you save money for later, okay, compared to, think about New York, think about the United States. Because although Either we don't have lockdown, there's a drop in economic activity, and we're prolonging the effect of the disease. So I think that India had a very reasonable policy. India, Taiwan, Hong Kong, New Zealand, Australia, these many countries had very reasonable policy. They acted early. They acted wisely. They acted according to precautionary principles. And they had a morally acceptable stance. And let me talk about, if you don't mind, about my moral stance. Saying we're going to sacrifice the elderly because you know what, we don't need them anymore, is something that would not cross any mind outside Sweden or some countries, some rich countries. Okay, so what we call geronticide, killing the elderly, by saying this disease doesn't affect the young, which is actually bad reasoning because we know that disease also affects many young. Okay, and we don't know, as I said, the long-term effect. But seeing these stances, okay, that they're morally not acceptable to many cultures, and including the Indian culture where you have respect for the elderly. You see, they're not accepted by Mediterranean culture. Because for the Romans, senatus means the older person. This is why they had the Senate. The Senate is the council of the elders, okay? So not only you wouldn't kill the elders, but they had a prominence. And the Arabic word shaykh, what does it mean? It means older. So seniority in age was effectively social seniority, intellectual seniority, and political seniority. So what we're facing here is a divide that few are noticing between the two worlds. Okay, the world that has the ancient world imbued with ancient values, and a new world that succeeded economically over the past, say, 75 years. Okay. And now we're seeing that maybe their moral advancement is not there, and that's going to cost them. And even then, now Sweden, for our friends here who don't know the story, has decided to let the thing go. Okay, they say, okay, it will burn through the population, it will kill a few people, and then the young will not be affected, which is turning out to be a very bad idea because many young are affected. We don't know if something they call herd immunity works. We have no idea. And what is worse is that their economy is also suffering. You see, this is the poetic justice, is not only they're killing the old people, but their economy is also suffering. So this is why, I mean, so sometimes people put you in front of a dilemma. Okay, this is a cost benefit analysis, and a lot of countries, including India, including, countries in Southeast Asia, countries in the Middle East and the Mediterranean, would refuse that on moral grounds.
Before I get into India's specific question and we start talking about risk, as a statistician, I'm sure you've studied viruses and the history. This virus has seen a winter and a summer. It has survived. Monsoon is about to come. It has only started in Japan and parts of China. Do you think the virus could spread more, or it could be normal?
Okay, we don't know. The idea, you see, let's look at the reasoning of why we're talking about pseudo experts. That we've discovered, my friends and I, we study macro things, okay, macro properties. I just have a paper coming this week in either this week, next week, in Nature Physics on what we call the fat tails of pandemics, which is effectively what drove me to write that comment that you nicely put in the Black Swan. I mean, the comment in Black Swan that I nicely mentioned. That was driven by some kind of, anecdotal empiricism I did that we formalize now with Nature Physics. You look at the macro property, the systemic effect, you don't go from a micro to the macro, you go from macro properties to micro decisions. So it turns out that people involved in medicine were too myopic to understand that maybe it's not the thing you have. Whereas when you look at macro, you're much more skeptical about claims. So in the beginning, they thought it was like SARS. And on January 26th, when we issued our warning, we said, maybe it's like SARS. Okay, we're all okay. Maybe it's not. Okay. So now there are a lot of things saying maybe it's not. So the claims were initially that don't worry about it. Wuhan that was in January, has a harsh winter. Look at on TV all their hats and stuff. Therefore, countries that are warm don't have that, and effectively, the influenza. Okay, and people thought, oh, just another flu, maybe a little worse, but within the same category. So they had a category error. So they thought that viruses, okay, this class of viruses, for some reason, okay, do not like summers. Either because more people are outside, or maybe because the nature of the virus doesn't survive on surfaces, whatever. And then they had a lot of theories. And then we said, you can't. Okay, because we still don't know enough to make these assumptions. When you model, you have to look at the macro properties that are robust and common to all diseases. And the more you know, the more you can narrow it to the category and say, oh, less harmful than, but here we still don't know. In the absence of information. Okay, and we still have no information. We still do not know anything. People were not recommending masks till recently, when in fact masks would have saved the U.S. economy. You see? So even the President Trump doesn't use masks, but they didn't realize that from the beginning, okay, they thought that like some other viruses, it was transmitted by contact, not via aerosol or droplets in the air, and it's turning out not to be true. And masks are incredibly effective, okay, for things that are respiratory because it's filter on both sides, okay, and compounding the filter works very well. After 2 or 3 person, you can pretty much lower the transmission. Anyway, so what I'm saying, so to summarize, it is, we cannot make assumptions of seasonality before seeing a lot of seasons, okay? So I would stay on a maximal alert. I would hope, that summers would high temperatures, humidity will harm it. But in the meanwhile, I would wait.
Okay. Now, before I shift focus to risk and asset allocation, I'm going to just read off for everyone in the webinar one quote of Mr. Taleb. People have the problem of denial. This is one of the biggest things I have learned in the Lebanon. Everyone who left Beirut, when the war started, including my parents, said, oh, this will last 2 weeks. It lasted 17 years. I guess that is what he's trying to refer to this virus. Please don't be in a denial mode. Learn to live with reality that virus is here. Like he told us a couple of days ago, plague lasted for more than 200 years. So I'm going to just shift focus, Mr. Taleb, and talk about what should one do. You're a risk taker, you are a trader. Yes. Let's understand by where are you investing and how are you investing personally?
Okay. Yes, in Skin in the Game, I said that I will never recommend anything that I don't have myself out of for moral reason. That way, if my recommendation is wrong, I lose money. It's good. I have good conscience. I hate gold. I've always hated gold. Unfortunately, I own gold. Okay. I hate European currency. Unfortunately, I own some European currencies. I like land. Okay, so I own land. I own olive trees. It's not economical for now, but I feel comfortable. Why? I feel it's a good repository of value. So now let me tell you what's driving my thing. I have 2 fears. Okay, one fear is of deflation and one fear of inflation. And I've learned through history that there's no such thing as inflation anymore. Okay, there's hyperinflation or nothing. Okay. So now we are in an deflationary environment, okay, not for some things, okay, but typically you can feel a deflation. It can switch very easily because it's throwing so much money at it into something great. So I want to hedge to make sure my funds, my savings, that they are unaffected by both deflation or hyperinflation. Okay, so I have a large portion in things that for paranoia. I am making bets. Odds are I will lose on them, but they're usually protected bets against long-term bond rates, because I think that eventually, if they keep at some point, even the government of the United States, you see, if the Chinese stop buying bonds, okay, the Arabs stop buying bonds, even the government of the United States may not be able to issue bonds to pay for this, okay? So you cannot just have the Federal Reserve buy your bonds, okay? it becomes sort of so circular. So, and I have, of course, what we call tail risk hedge. And I would like in phase 2 to invest in some businesses that are both robust to recovery from this and robust to the virus. You see, some companies may not be robust to the recovery. Like, for example, delivery services. Okay, a lot of people may not be. You know, these are booming. Where I live, you have food delivered, stuff delivered. So Amazon may suffer a little, okay, if you have normalcy, but there are some businesses where I think like what we're doing now, Zoom or some other, they may gain because we've discovered a new way of doing business, and a lot of employees would like to stay home independent of the virus simply because they find it more effective to not commute. Some people commute for 3 hours to New York City. So there's some habits that would be permanent. So try to identify companies that are robust to both the recovery and boom during the virus. Then, and as you said, I would hope that this will last 2 more weeks, but I will act as if it's going to be 17 years. So there's a difference between you know what you hope and how you act.
If I increase the time frame, which is terminal. A lot of experts use that. Let's look at terminal investing. 1 year, 5 year, and 10 year. Would you still like to buy gold in every basket?
Okay, so let me tell you one thing that one dogma I have. You should invest for tomorrow and you invest for 100 years in exactly the same way. And let me make an anecdote. The main difference between an investor, what's the difference between an investor and a trader? Well, a trader who loses money on his trade becomes an investor. So I'm in it for a long term. If they make money, they get out. So you cannot divorce. If you depend on what happens tomorrow, if you cannot say I invested for 100 years, if you ever had to change allocation tomorrow based on new information, then you're investing for 1 day. So this this is a big thing, and actually it was strangely enough in my first technical book published 23 years ago, Dynamic Hedging, where you explain that it's what they call the Markov property. You see that there's no and effectively it's a wrong way to approach problems. I want to invest for tomorrow. Okay, but I treat the same way. So and it's the same reasoning as saying, oh. Plane crash. We have plane crashes on average every 20 years, but I'm only going to travel for 2 days. You can't really, it's a memoryless process. So this is how I treat it. So I would treat everything at both short term and long term. Okay, and I would say everybody should do that. Because if you invest in say I'm investing for 20 years, if there's any reason for you to change allocation tomorrow, because you found something monstrously more attractive, okay? You saw the great mansion, someone's bankrupt, selling it, and you switch out into this, then you're effectively investing for 24 hours. You see? This is what I call the memoryless investing, okay?
Bala is on the other window and he's smiling. So Bala, was that in reaction to when he says that invest in gold or something else, Bala?
I like the word that he used. A trader, when he loses money, he becomes an investor. So that's what normally happens in markets such as today. So since you have asked me to react, and I also have questions to him, that we have a lot of audience who have been advising lots of the investors to put their $1 billion of hard-earned money into the market. What is your one advice to them that as to how one should they go about advising their customers, communicating at the regular interval for constructing a good portfolio that can deliver long-term return?
Very good. That's great. I'm shooting for long-term return, but I'm investing, with them in mind what can happen tomorrow. The most important thing is to be able to trade out of what you have. The most important thing is liquidity. So I think that the gods created financial markets for us to be able to change our mind. And this is invaluable. Like, for example, if I invest in something that I can't sell for 20 years or 50 years, okay, then I'm losing optionality, because if I find better investments, I'm telling you, if tomorrow you walk down the street and someone is selling something the equivalent in size to the Taj Mahal, right, for almost nothing, okay? So all your investment strategy goes out the window, because this is so attractive. You have to be able to switch. It's the same thing when we call that optionality. You have to invest in a way that allows you to get out. And this is why financial markets are extremely useful, because you can get out, okay, to find an alternative. You can switch to something, you see. It's still a very good investment, but I can switch out of it, you see. And that is central. Okay, having, like, for example, I own land and it's not liquid, and if I discover there's something vastly more interesting, I cannot get out quickly. So I have to have small allocation to that. The second thing I advise all investors, okay, is if you want to invest, say, 20% of your money in financial markets, invest 12% and keep 8% dry. So when you get a phone call for something attractive, you can increase, you see. And odds are there's a very small probability of you're not finding other. So what happens is that power dry is what people underestimate. Most people tend to overallocate early. You see, it's much better to overallocate late than early. So you see, so if I want to put 20%, you can convince me that there are things, okay, that can be attractive, okay? I will not be able, and also be flexible. I may have to increase to 30%. If it's very, very attractive, there's no point not getting into something. You see, if I see a company that produces monstrously stable cash flow and has all the attributes I like, and you know, okay, I will invest more. So there is some. First of all, you have to pay for flexibility by being sometimes underinvested. And the other is you may want to accept an overinvestment. So you should have a band of what is your average target, what you should be invested, you know, you should learn to invest under it and over it. So put a band. I want to be invested between 10 and 30%. My target is 20%. I may want to increase. Or you can be, say, 50%. Whatever your allocation is. 50%, I may want to go to 60 or 40. And that is central. And also, every day wake up telling yourself, okay, forget what I've invested in. This is memoryless, okay? We traders should have no memory, okay? It's sunk cost. Forget what I've invested in. If I were to do it today, will I buy it today? You see? If I didn't have it, will I buy it today? Yeah, if I want to buy it today, yes. If I wouldn't buy it today, forget your past history, right? Because that is what blinds us to find something else. Oh, I wouldn't buy it today. Okay, then let me sell it and buy something I would buy today. So the cost of switch, the beauty of financial markets, particularly in their boom since like 95, 96, and this worldwide boom that we've had early in the bond market in the 80s, late 80s, and now in equity markets worldwide, it allows you to get out and switch. So there's no reason to sleep on something you don't like now. In the past, you're stuck investing in a company. You have to wait 5 years before you have a meeting, you know, with, you know, about, you know, to be able to get 10% of the money back or something. Now it's one phone call, not even a phone call. It's a keyboard entry.
Bala, any follow-ups?
No, I think I just I think you have advocated managing without buffer was irresponsible. That's the word that you have used. Does it also mean in times like today, one should also keep an eye on emergency fund while doing allocation to various asset class? I mean, you mentioned about land is illiquid, and does it also mean that one should also have an emergency fund?
Yeah. I mean, the idea is, again, never to be invested 100%. Okay, have emergency fund. This is what I call the barbell strategy. You have one part very risky, you know, but not all your portfolio, and one part, minimum risk possible index for inflation. You see, and I put actually my land in a safe part because it produces olive oil. Okay, so I put it in that category. Now, by the way, I forgot to say I'm extremely honored, to by having this. And thank you for inviting me for the Diabella mutual funds. This beautiful convention that's taking place online was great questions. So let me thank you.
That's what I'm doing.
Okay.
You can experience, right. That's what I'm expecting.
Okay, that's good. Okay, that's fine then.
Really, on the lighter side, you must be the happiest man. No haircut.
Sorry? No haircut. Yeah, I have. Okay, this is another industry. No, okay, there are industries that I bet you will come back. Okay, even if we have a lockdown for 17 years, all right. The first thing I'm going to do when I exit from it is, because haircuts got to be done by someone. Haircuts, dentists, and stuff. Everything else you do virtual, but haircuts you cannot do virtual unless you come up with an idea, and I would invest in that company.
Okay, Mr. Taleb, we know about your writings. We know about your thoughts on socialism and financial markets. As a trader, very little is known about what you've done in the past. If you have to talk about your favorite trade, and perhaps a trade which you think you love the most or you still have it, which will be that classic Nassim Taleb trade? You know, Buffett takes a lot of pride in saying that, look, I bought consumer monopolies, I invented the word moats. What is that USP of yours? Okay, no, I have spent my career not as a real investor or trader. I'm doing complex derivatives and doing what I call tail risk hedging. But this is very professional and for specialists. Things that pay off big time if there's a catastrophe, or if there's good news, these what I call optionality. So I would say that I would not recommend anybody from the general public to do it, because it's very technical. Transaction costs can be hidden, okay, and prohibitive. But I would say, and I would say also, I'd rather be asked, what is your worst trade? And I'll tell you how my worst trade has made me probably richer than my best trade, and I'll explain why. But let me say in general, what I think is the trades that I've done right is having trades with bigger upside than downside. And that I explain in my book, Anti-Fragile. For example, instead of buying gold, and also I forgot to mention, I have gold, but I also have gold mines. Okay. Why? Because a gold mine gives you the upside of gold without the downside. I have metals mine, other metals mine, things involved in copper and stuff like that, simply because that way you don't have to carry the inventory. It's in the ground, and it's like a strike price. It's like an option. You have more upside than downside from gold mines. So they are volatile, but it's nice to have in a portfolio. So I think I've been quite the trades I'm comfortable, communicating to the general public that are very, very you generalize and an agreement with my idea of complex option is the trades of having gold mines have more convexity. That's what I would say class of trades. But you didn't ask me what the worst trade that I learned the most from. Yes. And I tell you, yeah. So, okay, I don't know if you've seen what happened recently. Oil prices going negative. Okay. The oil prices going negative. Now, what happened? It had happened to me in the 80s to have a very similar situation. So, in the 80s, we were dealing, and we ended up with having a contract, an option with a contract that forced us to get delivery of oil. And before you get delivery of oil, you have to inform the exchange, for delivery, where do you get your oil? Okay. And what happened then, there's a firm that acquired by Goldman Sachs called J. Aron, that was a bunch of shrewd commodity traders who squeezed rookies like me because they had rented, there was this oversupply of oil. That was the 80s. And, what happened is that they rented every single storage on the East Coast. And oil, when you receive it, it's like a bad gift. You have to store it somewhere. It costs you money.
and the EPA doesn't let you, dump it in the ocean. And they also rented every ship that can take oil to store oil on it. So then I learned, not to be squeezed, I was squeezed, we lost a lot of money, and I learned to not be squeezed again. Okay.
Great point.
And since then, sorry?
Great point. I mean, it's a great...
and it saved me so much money to not be squeezed. I was in my 20s, I had hair, and almost like you, or no, actually more even, I was the same. I had hair, I was in my 20s, and it felt so bad to have that big loss, as they say, is your best loss. And when people, and I'm proud of my best loss. I mean, I've had similar losses, where I get involved in something, and I'm caught because there's a detail that makes it different from other contracts. And oil, effectively, you see, stock you can receive, it doesn't cost you to get it. But oil, you got to store it somewhere, and you can't just throw it away. And you got to pay people to take it away from you. We didn't lose, it didn't go negative at the time, but we had to pay people. We lost a lot of money from what we bought this oil. Paid people to take it away, and of course they knew. And they squeezed us. So that's one example of the best loss. So I would say another best loss was when and again I'm talking as an old trader. So I remember the days when there was a cover story in Business Week, which at the time was a dominant financial magazine worldwide, and had a cover story on IBM.
Right.
As saying the Big Blue is the best company in the world. And this came in the nick of time, right before Apple came and almost destroyed IBM. And of course, IBM is a great story, and all my friends say, "Oh, let's buy, you should buy IBM." And I was right out of business school, and I went in and bought IBM stock. All right, and I lost so much money on it. That I realized that if it makes the front page of Business Week, or it means you don't want to buy it. It's too late. That's when you sell it.
Right. Okay. So, Mr. Taleb, every crisis gives an opportunity. That's what you've always said.
Yes.
When the TMT bubble got busted in 2000, money moved to emerging markets. When emerging markets, they started coming down, money moved to large US tech. Because of this crisis, what do you think would be the new normal of the world? Will US and China fight? Will globalization be under pressure? What are your thoughts there?
I don't think foreign policy is the place to look for huge rationality, with geopolitics. I don't think so. But I doubt that it will have tension between US and China, only because the two countries depend on one another. And there's too much commerce, too much at stake on both sides, and you need people to buy your bonds. You need, and then the Chinese need people to buy their products. So what I would think will happen is maybe a little bit of tension, because there are some initially now there's some things people say, they should not be made in China. Pharmaceuticals. So we're going to have some essential pharmaceuticals made here, maybe inefficiently, but as insurance. But we don't really care if this is made in China. My coffee cup, there's no particular national security involved in there. Or if my Apple computer is made in China, this is no big national security, and actually they make them in China because the Chinese are better at making, that Apple said they're better. It's for quality, not for price. So I don't think there'd be tension between US and China, but I always keep in mind that governments can be very irrational when it comes to geopolitics. And effectively, we can see it now with, my criticism of the U.S. government to say, you guys spend $1 trillion, plus more in hidden cost, building nuclear stuff, and you can't supply the population with masks, what world are we living in? So people are getting to be a little skeptical of geopolitics, and that's good news. So when you say, what is the new normal? I think, we still have a lobby that wants to sell planes, to third world, to Saudi Arabia or whoever can afford it. So That's going to be go away. All right. The second point: oil prices. Again, the whole idea of having a gray beard and soon white, perfectly white is, you remember war stories, okay? And I remember oil. Oil is vastly more vulnerable than people think. They try to maintain a production. So the world consumes 100 billion barrels, and they produce, say, 98 billion, right? So they supply the world a little less. They got us addicted to oil. And now it's turning out that a little drop in airplanes and stuff like that. Now they're on the other side. They need to produce more oil, all right, and we need to buy less. And we start to have small alternative things, like, for example, electric cars. Now, you may say it's small, but say, no, it's not small. It's marginally huge.
Okay.
Because if the demand goes from 100 to 90, okay, a million barrels a day, okay, that's huge for the price. And we saw that in the 80s. And I don't know if you remember, or if you've heard, or if you've read, in the 80s, oil collapsed. So I think that oil is vulnerable on the downside.
Right.
Now, unless, now let me ask you, do you own oil fields personally?
No, I wish I did. I don't.
Okay, no, you have it.
Bala only once. I mean, I don't know about Bala. He's got a lot of things which he never shares.
Okay, so unless you own oil fields, all right, the drop of price of oil is very, very good for you. Okay.
Yes.
That is what's central. So it's practically good for everybody except for Saudi Arabia. Or maybe it's even good for Saudi Arabia, okay? But we'll see. It'll force them, to really get into other businesses. It's good for peace, Saudi Arabia, Iran.
Right.
It's very good for promotion, promotion of things that are, religious fundamental. It's very good. The drop of oil is good for everybody except those who own oil fields, okay, the very, very small minority, and it's there to stay. And the thing is, when you think about it, this is there to stay, because the big consumers, or the places where we spend a lot of money on, are definitely going to be have in mind, okay, people will cut down on travel, okay, even if we had a short-term cure like that, people will cut down. They're afraid. They build new habits. They change in consumer habits.
Okay, Mr. Taleb, I'm just going to interrupt you here because I'm going to turn attention to lots of questions, and trust me, there are hundreds of questions because sometimes some will shift there. Before I go to it, I want to make a comment on a point which Mr. Taleb just mentioned, that learning from mistakes. And I'm speaking from experience. The man on the screen, apart from Mr. Taleb, my dear friend Bala, this AMC Birla AMC I've interacted with for years. Trust me when I say that. They are learning from their mistakes, and every time I interact and voyage with Bala and his team, I'm amazed with the processes they have in place. So Bala, my compliments to your team. Every time, like Mr. Taleb says, that you manage to migrate, you become stronger, you only become bigger as a money manager, as an AMC. But Mr. Taleb, a question coming from somebody who's part of the webinar: why is the dollar strengthening when US is virtually bankrupt?
Because other places in Europe is strengthening against what? Okay, it's not strengthening overall against gold. Gold is firm, although it was having deflation now, short term, and it is not. I mean, it's strengthening against Europe. Is that what we say? Strengthening against what? Again, depends on. It's strengthening against Europe. Okay, that is from what I see against UK, the euro 108. Okay, that's not. I wouldn't look too much into the dollar for now, and you remember that the U.S. is not presently bankrupt. They're still printing the reserve currency, and they haven't printed so far. The printing is a project, okay, which is static. The money has not been printed, okay. I mean, largely has been committed, okay, but it's. So we're in the third. We're entering the third month of printing. It takes a long time. Japan did that for how long? They've been doing it for 25 years, 30 years.
Okay. Another question from Nitin Sawan, and he wants to know, Mr. Taleb, you predicted the pandemic in 2007, the collapse of financial markets 10, 12 years ago, what is the next big calamity or casualty you want to put it?
I think I would be more positive about calamities going forward for two reasons. This pandemic taught us to deal with pandemics. Okay, we will know to react early and save ourselves money, because all these trillions spent by Western countries are caused by delayed reaction. Because think of Taiwan, they didn't spend trillions, right? They didn't have, the equivalent to their GDP. So I think that the world is safer today than it was a year ago. Okay, both economically and there. But we still have this government debt that needs to be cleared. And government debt is a problem that will definitely crop up, because when you enter debt, people ask you, why do you want the money? And then they start supervising your other expenditures. So maybe the financial market will give the US government money for stimulus and stuff like that, but they tell them, listen, these $1 trillion we spend on weapons, I don't see, plus more. We spend so much on Gulf War indirectly, plus the liabilities you get from it. Liabilities in terms of, pension funds and stuff. So that's where we can cut. Okay. And also there's another thing. Is academia is not doing very well in America. Okay. Getting expensive, doing nothing. And for any subject, say epidemiology, right? You can find better experts outside academia than inside academia. Like Stephen Wolfram, for example, and his son did an afternoon what took 15 years by a bunch of epidemiologists in the UK, team, the one that was advising the government. They did it, and then when we see their code, it's like, so what happens? Academia is becoming the refuge of of the parasite. Okay, and it's nice. We're going to have a shake-up in academia that will. So we can expect going forward a shake-up in academia, a shake-up of bad management in the U.S. for, because now guess who's coming asking for money? States. State of Illinois, the most inefficient operation in the history of mankind is the state of Illinois. And they ask us for money, us. So we're going to put that under scrutiny. And I think after some little bit of cleanup, the world will be better. So my idea in a black swan is I was identifying sources of fragility. And with this simple point is that once you identify fragility, you've removed it. You see, half the problem is figuring out where it is, right?
Fair point. Mr. Taleb, investing in India could be different, a question from someone, because interest rates are different in India. US has 0, India has 6. What do you think it means for a long-term investor? And part B of the question, based on your understanding of Indians, the demographics and the government, which are the bright sectors in India which could deal and survive the storm?
Okay, so I will say what last time I met you in India in December, and okay, of course I've been 10 times to India, but still ashamed of not learning Hindi because everybody talks to me in English. I want to speak some Hindi. So my project has been, thwarted by you talking to me in English, not forcing me to Hindi. Anyway, so I love India. And last time I was asked, okay, so the world, you remember there was a book that was a little flawed, that I critiqued called The World is Flat. Yes. And I said it's both right and bad book because he doesn't see the dangers of the flat world. Okay? Because we're seeing the world being flatter. Sorry?
That's Friedman for you.
Yeah, Thomas Friedman. I don't like him, and then he liked the Iraq War and stuff like that. Anyway, but I said effectively he's right on the world is flat and wrong on everything else. Okay, that's what's good from it, because globalization, okay, increases connectivity, bring both this virus and the economic difficulties we have dealing with the virus because of fragility of supply chains. So, but I said there are places. Okay, now what's happening is that the rise of the West, okay, English Industrial Revolution, and then France, Germany, and so that rise may be just a blip in history, because it doesn't look like the differential is, for example, if I want the best statisticians on the planet, I may find them at Tata Institute or India Statistical Institute. And of course, Zoom eliminates visa problems. So there's a lot of goods you can export now to the West in which you can have superiority. That's what my point is. The second one is that I don't know the structure of India, but I know that from my experience, is that you have a lot of talent, okay? You see, and you don't need a lot of talent to be able to export ideas, and this will be easier. And now soon we're going to have, I had to, I was offered a visit to a doctor for the checkup. They wanted to do it on Zoom. So if you can do a checkup on Zoom, why not do it in India? So that flatter world effectively favors countries that can still produce goods without too much administrative expense, that swelling medical bills and swelling university bills. So maybe there'd be a university degree in India or some modules sold out of India by professors in India, okay, that will be, can compete with anything here. So that's one thing about India. But so when I was in India last time, people ask me, what should you be doing? I say, I'm not an expert on India. As a matter of fact, I'm not even an economist. I'm a risk person. But I will tell you one thing, okay? And as an entrepreneur, risk person, I'll tell you one thing that I've learned. The main asset of any country is risk-taking. Is young people, when they graduate from high school degree and then they want to go to university, not to think that getting a salary is a good thing, okay? You want to fail when you're young, fail when you don't have a family, fail when you still, okay? And so they said, how can you say, look at California, it is acceptable to fail. So, and the highest bankruptcy in the world, before now, of course, it's the restaurant business, but before now was where in California, where in the most active sector, the tech sector. So they had California, Northern California, the highest rate of bankruptcy in the world of any region, and within that, in the tech sector. So we have high bankruptcy rate in the most thriving industry, what it tells you that people are trying, failing, and then trying again. So, and then they say you got to try 7 times. Well, maybe not 7 times, but still instill in young people that the idea of being an entrepreneur and failing is like a soldier who, is wounded in battle. There's nothing wrong with it, okay? And as a matter of fact, it's a badge of honor. And you have a very active tech sector, okay? And dangerously active for other